Have you ever felt like the market is rigged against you? You enter a trade, it looks solid, you've done everything right, and then boom, your stop loss gets hit, the market reverses immediately, and you're left wondering, am I just unlucky? Are the whales watching me? Why does this keep happening? Let me tell you the truth. The market isn't the problem. Your beliefs about trading are. Hi, my name is Janet and this is Trade Travel Chill. If you're new here, welcome. If you're returning, welcome back. Be sure to hit the like button for the YouTube algorithm and hit subscribe if you're not already subscribed so you can be notified every time I drop a new video. Today I'm exposing 6 of the biggest crypto trading misconceptions that are keeping you broke. These are things you've probably heard from YouTube, Twitter, or random traders in Telegram group, but believing them will drain your account faster than a scam token rug pull on launch day. So stick with me, because if you can let go of these misconceptions, you'll stop losing money, start trading smarter, and actually see results. Let's get into it. Alright, misconception number 1. Trading is easy money. I hear this all the time. I'll just put some money in, catch a 100x pump, and retire in Bali. Crypto is so volatile. I just need to catch the right move. I saw this guy on Twitter turn $500 into $50,000. Why can't I? And here's the truth. Trading is not easy money. It's a skill. And like any skill, whether it's playing an instrument, learning a sport, or starting a business, it takes time to master. I completely understand this mindset because I used to think the same way. Before I joined Trade Travel Chill, I was part of another trading community, and at the time, IDOs were the hot trend in crypto as well as NFTs. Every day I'd see posts from other people in our community getting into IDOs for insane returns. Some turned $1,000 into $50,000 within minutes. I thought, if they can do it, why can't I? So I jumped into the next IDO thinking it was my turn to hit the jackpot. And I went in heavy for someone who didn't have any experience with them, and it completely flopped. But did I stop? No. I told myself, okay, maybe I just picked the wrong one. So I tried again and again. I ended up investing in 5 different IDOs and every single one failed. I was chasing those big wins I saw others making, but what I didn't realize at the time was I was just gambling, not trading. But wait, there's more. Then came NFTs. This was a whole new level of FOMO. I really just wanted to hit a home run. The first NFT project I got into was a success and I made some returns. But here's where it gets crazy. That same NFT project launched a second round, then a third, then a fourth. And because the first one went so well, a lot of people thought, well, why wouldn't the next one do the same? And guess what? The second round failed, the third round failed, the fourth round failed. People who thought they had it all figured out suddenly lost everything. And that's when it hit me. I wasn't trading, I was chasing the hype. Luckily for me, I had only invested in the first round of NFTs and had now learnt some expensive lessons from being burnt from the IDOs. So here's the truth. Trading is a skill. The people who are consistently profitable in this space aren't just throwing money into the next trend and hoping for the best. They understand risk management. They know when to enter and when to exit. They aren't making decisions based on hype. They're following a system. And that's why the 100x overnight or the lottery mindset is so dangerous. Because yeah, some people get lucky, but for every one person you see turning $500 into $50,000, there are thousands who lose everything trying to do the same. Imagine 2 traders, Mike and Sarah. Mike believes trading is a lottery. He sees a tweet about a random altcoin going to the moon and throws in $1,000 with 20x leverage. And it pumps a little. His account is up $500. He feels like a genius. But then a slight retracement happens. The price dips just 3% and suddenly his entire position is liquidated. He stares at his screen in disbelief. What happened? He risked too much. No stop loss, no plan. He thought he'd catch the right move. Now let's talk about Sarah. Sarah knows better. She's been learning risk management and understand how the market moves. Instead of throwing money into a random trade, she analyzes the market, follows a structured system, and risks only 1% of her account per trade. On her first trade, she takes a small win, $30. Not life-changing, right? But over 10 trades, those $30 wins add up to $300 while keeping small losses. Over time, Sarah's account grows steadily, while Mike, well, he's back at his day job, wondering why trading doesn't work. So in a nutshell, we have Mike with the lottery mindset. He treats trading like a get-rich-quick scheme. He risks too much on one trade. He has no real strategy. He's just hoping to hit it big. He has high emotion, he panics when losing, and he's overconfident when winning. Whereas Sarah has a pro trading mindset. She treats trading like a profession. Her risk management is her #1 priority. She trades with a proven system instead of guessing, understands profitability comes from consistency. If you're still thinking, but I just need one big trade to change my life, let me tell you, one big trade won't make you a trader, but learning proper risk management, timing, and a solid system, that's what will make you profitable. And trust me, once you see trading differently, you'll never go back to gambling on hype coins. If you want to trade with an actual system that helps you stop making emotional mistakes, stick around. I'll be breaking it down as we go. Most people think the secret to making money is winning a lot of trades, but here's the truth. You can be profitable even if you only win 40% of your trades. It's all about your risk to reward ratio. If you risk $1 to make $3, you can lose more trades than you win and still make money. But most beginner traders only focus on trying to win more instead of focusing on how much they lose when they're wrong. Here's a real example. Imagine you take 10 trades and you only win 4. If your wins give you 3 times what you risk, you're actually still profitable. But if you're risking too much per trade, even a high win rate won't save you. This is why traders using the TBD system focus on the right trade setup, not just winning every trade. Misconception number 2. Indicators will tell you exactly where to buy and sell. I see this all the time. Traders relying on indicators to tell them exactly when to enter and exit. They wait for a crossover, a signal, or a confirmation, and they think, okay, now it's safe to enter. But here's the problem. Most indicators lag behind price. Let's take EMAs for example. Now EMAs are great for spotting trends and giving us a general idea of market direction, but they're not magic. They work by averaging past price data, which means they react to price movements rather than predict them. Let me show you. Look at this price move here. The market has already made a significant move to the downside, and only afterwards do we see the EMAs cross. If you had waited for the EMAs to cross, then you're essentially chasing price, because these EMAs didn't cross until price had already made a significant move to the downside and price was down here. Let's go back and have a look at some other EMA crossovers. For example, price had already made a move to the downside. The EMAs didn't cross until price was here, meaning you've missed out on majority of the move, and there was only this small move to the downside before we had a complete reversal. Again, we see price make the move to the upside. The EMAs cross when price was here, meaning you've missed majority of the move. Now that doesn't mean EMAs are useless. We very much use them in the model we trade. However, think of EMAs as dynamic support and resistance levels that move with price. When you draw normal support and resistance levels, it's a static line and it doesn't move unless you go in and physically move it. However, with EMAs, they act as support resistance levels that move with price. So here you can see price broke the EMAs and then it held as support before making another move to the upside, held as support, then dropped to the next EMA, held as support, and then finally we broke it. The more times price touches a support level, the weaker it gets. So hence why we broke through. So now we would be looking at these EMAs to act as a resistance level. So once we broke through those EMAs, we can see price came back to retest the 50 EMA before more downside. Now we have broken through, but we're not out of the woods. We would look to see if we reject the EMAs yet again, because that would act as our next resistance level. And if we manage to break that one, then we have the 800 EMA, and we'd pay attention to that one to see if it acts as a resistance as well. So we'll find often that when price pulls away from the EMA, it will be attracted back to it at some point in time. And that's why it's a dynamic support and resistance, because they move with price. See how price moves away, pulls back into the EMAs, finds support before pushing away again. This is a much better entry than waiting for the EMA crossover. And actually, now that I look at it, if you had waited for the EMAs to cross over before entering, let's not forget I'm on a daily chart, then there was no EMA crossover and and you've missed most of the bull market. The EMA crossover presented a lot earlier, and it was back here when price was around 25,000. And same with current price action and the daily time frame. We have not yet had an EMA crossover. If price is to make another move to the downside, then we may get the EMA crossover. However, that may not happen until price is here and you've already missed out on all of this move because you were waiting for the EMA crossover. As long as the EMAs are trending up and to the right or down and to the right, then you are in a trend. If they start to flatten out, then the trend has more than likely slowed down and price has started to go sideways, or it is getting ready to reverse. Another lagging indicator is the RSI, or relative strength index. You've probably heard the classic advice: RSI over 70, time to sell; RSI below 30, time to buy. Sounds simple, right? Here's the problem. RSI is also a lagging indicator. It's based on past price movements, so by the time it signals overbought or oversold, price has already made a big move. RSI, like other momentum indicators, measures the speed and magnitude of recent price changes, and it does so by looking at past data. The price has to move first for the RSI to start moving in that direction, meaning it moves with price with a slight delay. For example, in a strong bull run, the RSI can stay in oversold for days, sometimes weeks. If you sell just because the RSI is over 70, then you could potentially miss out on massive gains. Same thing in a downtrend. Just because the RSI is below 30, it doesn't signal that it's an automatic buy. Buying too soon just because the RSI is below 30 can leave you catching a falling knife. So how do you use RSI properly? Instead of using it as a strict buy or sell signal, use it to spot divergences and confirm trends. For example, on the daily time frame, you can see price has made a move to the downside, and on the RSI, we have also made a significant move to the downside. However, if price is making lower lows, but the RSI is giving you higher lows, that is a sign that momentum may be shifting, essentially giving you a bullish divergence where the chart gives you lower lows, but the RSI is giving you higher lows. That is what you call a bullish divergence. Same with bearish divergence. If price is making higher highs, but the RSI is giving you lower highs, that could mean buyers are losing strength. So instead of blindly buying or selling based on RSI levels, use it as a tool alongside price action, structure and volume. The key is to use them in confluence with price action, not as your sole decision making tool. This is why experienced traders use indicators as a tool, not as a magic signal. The TBD system, for example, doesn't rely on indicators alone. Instead, it looks at market structure, liquidity and timing. That's why so many traders get stopped out using generic indicator strategies. By the way, if you're looking for a reliable exchange to trade on, consider checking out Bitunix. It is no KYC, no VPN, so you'll be able to get access to this one worldwide. By using the link in the description, you'll get a 20% trading fee rebate on all of your trades for life, so you can keep more of the profit. Misconception number 3. The market is random and unpredictable. Ever heard someone say crypto is just gambling? That's another misconception that keeps traders broke. The market isn't random, it's manipulated. Market makers and big players don't just react to price. They move it intentionally to fill their own positions. But here's the thing, to do that, they need liquidity. So when we enter a trade, we're either buying or selling to someone. The market makers who have massive capital can't just buy and sell and have their positions filled like ours. If they were to market sell their whole position at one point, price would absolutely dump. And the same the other way, if they were to market buy, price would skyrocket, giving them a bad average entry. This is why price often moves sideways before making a big move. During this phase, market makers are slowly accumulating or distributing their positions, buying or selling little by little to avoid causing massive price spikes. And if they haven't filled their position, this is quite often where we'll see the fake outs, or what we call stop hunt. For example, market maker knows where retail place their stop losses, just below support, just above resistance, or at key psychological levels. So what do? They let price bounce at support, and they'll let price reject at resistance, and price will start to move away, inducing retail into a position. However, falling short of most retails take profit areas before reversing price to trigger those stop losses and liquidations, forcing traders out of their positions. And once they've collected all of that liquidity, that's when the real move happens. It's a game of deception, and if you don't understand it, you're the one being played. This is why traders using the TBD system don't just trade blindly. We watch for these manipulations and trade with the big players, not against them. If you think the market is random, you're missing the bigger picture. Misconception number 4. You can learn everything for free. Look, there's free content everywhere, but the best strategies, the real insight, the actual mentorship, that's behind paid communities. If you're serious about improving your trading and want to learn this method in detail, consider grabbing yourself a TTC membership by using the link in the description. We've just launched our brand new 𝗖𝗵𝗶𝗹𝗃 membership, designed to make learning this method even more accessible. Now you've got 2 options to choose from. The business class membership is perfect for self-paced learners. You'll get access to all of our courses, daily written market updates, our custom trading view indicators, and our recorded live sessions. If you prefer structured education without the distraction of live chat, this is for you. The only thing not included is direct access to Annie or the team. But if you like to learn on your own, everything you need is in the courses and updates. And the best part, it's under $100. Then there's the first class membership. This is for those who want hands-on support and real-time interaction. You get everything in business class, plus direct access to the team, live session participation, and high-level community discussions. All memberships come with a 48-hour money-back guarantee, and you can sign up monthly or pay upfront for a discount. And for those who prefer to pay with crypto, we've made that super easy. You can choose a 6-month or yearly payment option. So whether you like to learn solo or thrive in a group setting, Annie has built these memberships to give you exactly what you need. Misconception number 5. More trades equals more money. The truth, overtrading is one of the fastest ways to blow your account. A few well-planned trades are way more profitable than constantly jumping in and out of the market. The best traders wait for the right conditions. The TBD system teaches traders to only trade when the market is favorable, instead of chasing random moves. More trades equal more risk, more time, more stress, not more profit. And now, bonus misconception. You need a huge account to make money. A lot of beginners think they need thousands of dollars to start trading, but in reality, a small account with good risk management can grow way faster than a big account trading poorly. For example, in a previous video, I showed you this trading account on Bitunix. It started with just $1,000, and through proper risk management and disciplined trading, it has now grown to $2,400. No crazy leverage, no reckless gambling, just following a solid trade plan and letting consistency do the work. That's why the TBD system focuses on high quality setup and proper risk. Even with a small account, you can compound over time if you trade smart.